Hey everybody, it's me, Alex, over at Jet Lending, Senior Vice President. And as promised, we are going to continue on doing some live instructional type videos to help you guys increase your knowledge base and increase your wealth by doing things a little bit more streamlined and better for your business plan. So today, we are going to go over leveraging to buy real estate that you're going to hold. Now, what does that mean? So when you are looking to buy real estate, a lot of times people start off as like wholesalers or flippers or things like that. And yeah, you can make a lot of money doing that. But if you ever want to get to a point to where you are, where people say independently wealthy, it means you got to start holding real estate. So one of the best ways to do that is by leveraging somebody else's money to buy it. Sure, you can buy these all cash. Your ROI is at infinity, but unless you have a large amount of cash sitting in the wings somewhere, it's hard to buy 10, 20 rentals, whether they're short-term or long-term, if you don't have that money. So you're going to have to leverage them. You're going to have to get loans to buy these. Now, there's a couple different ways you can do this. You can buy property where you're buying properties that are already fixed up and you're just getting a long-term loan. That's one method. You can buy properties that are extremely distressed and fix them up. You could buy properties that just need a little bit of work and then you can fix them up, and you can get them in private money loans or asset-based loans like a jet lending, where you may have heard hard money. It's asset-based. You can do that. One of the ways we're going to go through it today is how do I get like a private loan or an asset-based loan, fix up the property, and then refinance it, and what's called a non-QM loan. Cool thing about those are you can do as many as you want. They're based off the individual asset. So if you want to buy 20 properties, you don't have to do what like Freddie and Fannie stuff where you have to show the PITI for the last 6 months of properties per property or anything like that. You can boast on the property that you're buying or refinancing. It's not based off your income. So that's how people excel in number of inventory with the non-QM space. All right, so what I'm going to do is I'm going to share my screen here so you guys can actually see the math of this, of what it takes to do this. Okay, so, all right. So this is a real deal. We got somebody that closed, and we're going to show you what the numbers look like so you guys can start calculating how does my rental have to work for the amount of money I have to buy more rentals, okay? Because you have to have some liquidity. Now, on your short-term side, when you're dealing with a true loan-to-value lender like Jet Lending, you could buy these with $0 out of pocket, okay? This person did. So I'm actually going to increase the purchase price because this person just got a smoking deal, and they tend to get a lot of smoking deals. I'm pretty proud of them. But we are going to show you what it looks like on your short-term side and then what it looks like on your long-term side so you can calculate how many can you do. And this is what we do in our analysis. Not only do we comp the property, we comp your rents. In fact, with the short-term rentals, we even can look through like the AirDNA to see if you're doing a short-term vacation type rental like the Airbnb and the VRBO stuff. We do that as well on 30-year fixed on the non-QM space. You can buy them, or you could fix them up and refinance them long-term and non-QM space. So let's take a look. So let's say this person bought a property for $94,500. They are going to make this. This was going to be a short-term Airbnb type property. They're going to put $75,000 into this property. The yearly taxes were $2,222. The after repaired value off the comps and the appraisal were $235. Now, just a side note, if you guys did not watch the last week video on how asset-based lending works, remember the appraisal. The appraisal means more in this section than it does when you're flipping. And the reason why I say it is you can line up 50 appraisers and get 50 different numbers. And that's not the point. The point is that an appraiser is a licensed personnel that's going to give you an opinion of value per the comps that they see within the last 6 months. So the reason why this is more has more weight when you're holding real estate is that when you're dealing like with someone like Jet Lending, we lend off what we see in the market. We've done over 3,500 loans. One of the owners of the property, Eddie Gant, he's bought in thousands of properties. We have an idea of what things are worth. But when you do long-term stuff, whether you do non-QM or bank or credit unions, basically off the appraisal and the value. So always be wary that if you do your short-term renovation side and someone says, well, I don't think you should get an appraisal, I think it's worth the $500 to see what a licensed personnel would deem it valued at, so you don't take a $10,000, $20,000 hit on your refinance off of the projected value. Okay, so this appraised for $235,000, and then the insurance quote came in at for the hazard and wind at $2,671.98. So we lend up to 75% of the loan to value, and we hold repairs and escrow. This is why you want to do that, is because as you complete the work, we reimburse you the work. You don't have to hold your repairs and escrow, but what I like to tell people is when they're growing is liquidity saves you. Okay, so if you had 75 grand in your bank account and you'd make the argument that says, well, Alex, I want to use my money because I don't want to pay interest on the repaired escrow. We'll get into that in a second. So I'm going to use my money. My argument to you is I'd rather you buy 2 or 3 more properties, leverage that income or leverage that capital to buy more inventory. Also, let's say there's a shift in the market and you don't have any money now because it's in the property, it's in a fixed asset, it's no longer liquid. So now you're in trouble. The people that get in trouble in this industry is the people that do not stay liquid. Okay, so leverage that asset, leverage that money, keep liquidity in your pocket to remain safe. The second topic I'm going to mention on that is you may notice that some people say, well, I'm not going to charge you interest on your repair escrow. Make sure you ask this question. This is very important. The reason why Jet Lending charges you interest on your escrowed funds is that we actually take it from our bank account because we're not a brokerage. We lend about 70, 80 million of our own capital. And we put it in an escrow account. That escrow account is deemed for your property. So when you ask for a draw, your money's just waiting for you to be reimbursed. There's nothing more frustrating that when you're doing a repair and you call for a draw and your lender doesn't have your money because they're waiting for somebody else's deal to close. So whether you're using private or another lender, just make sure that you have your funds in escrow, okay? Because that is going to save you. There was a time in 2017 where that happened to a lot of people and we couldn't help them out because they were already in hard money loans and it was a mess. So please make sure you protect yourself. Do not nickel and dime. Always project risk. Take a look at our last week video. It goes into a little more detail. So let's say you're at 3 points at 9.9% interest-only payments. There's never a penalty for early payoff. If you scroll down here, this person came out of pocket about $5,208. Now you're saying, Alex, it says your closing cost is $11,958. This is what I mean by loan-to-value lending. You guys will see a lot of people that says, I'm a loan-to-value lender, I'll lend up to 75% loan-to-value. However, they will say, also, you have an 80% or 90% loan-to-cost at closing. So that's my phone. So if you're at 80% or 90% loan-to-cost at closing, what that means is if you, let's say you purchased a property for 100 grand, and let's say with this market it was worth 105. Okay, that means you'd have to come out of pocket 10% of the 100,000 plus the difference of the 105, which means you're coming out of pocket more. Now, I'm not saying that there's not times that loan to cost doesn't, work well. I'm just saying just be aware of the math of what your spread is to see how much you're coming out of pocket. As you can see, the person was buying it low enough that they bought it at 94.5 because I'm loan to value. I was at 75% loan to value of the 235, which is 176,250, minus the 75 to hold in escrow. So I was closing 101,250, which is above the 94.5. You may have heard people say you can buy real estate with no money down, or you can come $0 out of pocket at closing. And that's what they mean. They lend against the spread of how you bought it. So if you ever want to get even more, now this client, because I wanted to show you something that was a little more of the norm, they actually bought it for $75,000. I mean, this is a real deal that happened to Jet. They were $0 out of pocket at closing. Okay, that we do $0 pocket deals all the time, but this kind of spread here, especially in this market, this wasn't the norm. So I wanted to show you guys something that was a little bit more of the norm. He got it as a smoking deal in Galveston, and he does great work, and it's going to be a fantastic Airbnb. So he came out of pocket $5,208.23. So you have interest-only payments when you're in a short-term loan when you're doing your rentals, right? So your interest payments was for $1,454.06. Then you have your monthly property taxes. The reason why you should consider holding your property taxes in escrow while you're in the short-term loan and possibly your long-term loan is because when you refinance this property out, just like last week when we talked about selling your property, those taxes have to be transferred to your lender if they're holding for escrow for taxes. Let's say this deal closed in January and you refinance in October. So those 10 months of taxes have to be transferred to your new tax escrow account that will be paid at the end of the year, okay? So if you don't hold your taxes in escrow, that means when you refinance, let's say you refinance with your private bank, those monies, if they're going to hold that in escrow, have to be deposited. You have to come up with them sometime. So you have to evaluate the risk of does it make sense to hold my capital or not? A lot of times I'll hear people like, well, I can put that money to work and have it work with me. You never put that $168 to work anywhere else. I would rather just put it in an escrow account so I know my bills are paid so I can focus on making more money elsewhere. But choose what you want to do for your business plan. On your short-term side with Jet, you'll hold those property taxes in escrow to make sure you can pay your taxes or give it to your bank or buyer if you sell it at the end, okay? So on this deal, you have to show that you have access to by income, other rental properties, cash in the bank, lines of credit, anything you want like that. You have access to about $39,000. It's not black and white, it's just a little bit of gray to know you can span the deal. $5,000, $5,208 is going to come out day one. I want to make sure that you have at least a third of the renovation budget, at least 6 months of interest payment so I know you can pay your bills on time. And as you're completing the repairs and I'm reimbursing you, you can keep the project moving as I'm reimbursing you. So I don't take the funds. I just need to see that you have access to it somewhere, whether you could be partnering with somebody, whatever you want. Okay, so if you bought this deal, okay, you're in this property now for $5,208 plus all your monthly interest payments as you go on. You know, you're in it for 3 months. You take 1622 times 3 kind of thing. And we're going to show you what that looks like. All right, so let's say the hazard insurance was $2,671.98. The flood insurance, because it was in Galveston, was $1,404. There was no association dues, vacancy and maintenance. Now, this is a business. This is a judgment call for you. People tend to withhold about 20 to 25% in vacancy and maintenance when they're evaluating their profits of a property. Okay, so that is going to be surely business for you. I've seen people go as low as 18%. I think that's probably a mistake, but do run your business the way that your numbers are good for your business. So let's say we hold 20% in vacancy and maintenance. Okay, this comped as a long-term rental for $1,500 a month. It's not currently rented because it needs $75,000 worth of repairs. Now they're doing 75 because they're making an Airbnb, but in this area for that square footage, $1,500 was reasonable by the appraisal, was appraised. All right, you're going to refinance it at 75%. Now, if you notice, I'm lending 75%. So if it appraises well at 235, you're just going to be out of pocket some of your closing costs on your refinance. For any reason, this is why I told you the appraisal is important on the refi. For any reason, let's say this appraised for 250. you'll get refinanced at 75% of that 250. But the other thing can happen too. If this appraised at 218, that's what I was telling you about getting the appraisal. You're like, oh, this is 235 all day long, and you keep getting appraisals at like 218. Plan your numbers on your refinance at the 218 because that's what the licensed appraisers are saying. So you can project if you are out of pocket even more at your refinance. Okay, so don't get caught up on getting more money on your short end if you're just going to end up taking a bath on the long-term refinance. So you're at 75% loan to value. The lowest interest rate right now is that 3.85% on the non-QM space. I've seen that a few times. Most likely you're going to end up in the low 4s to low 5s. Okay, I'm seeing about 4.5 commonly with the loan to value people want to get. It's a 30-year fixed. And let's see here. And then the out-of-pocket cost was 5,208. All right. Now, in 2019, we appreciated about 9%. In 2020, we appreciated about 18% in Houston. In 2021, it's looking to be closer to the 18% again. But let's just use a non-crazy year, and let's say this appreciates 10% on average. All right. So you got your monthly taxes. There is no association dues here. You always got to calculate your association dues, and this is why. When you do non-QM or non-qualified mortgage loans, it's based off something called the DSCR, the debt service coverage ratio. And what that is if your mortgage, your principal, your interest, your taxes, your insurance, and any association dues, that's your mortgage. If you had to get a 1.2% DSCR, that means that your property has to rent for at least $1,200 if your mortgage is $1,000, a 1.2% ratio. So that's why association dues really come into play. They're not so detrimental in single family homes, but they can have a huge swing in townhomes and condos because they can be up to $200 a month depending on your amenities. So really pay attention to association dues when you're dealing with townhomes and condos. Right now, they've had a 20% vacancy in maintenance with paying themselves back their closing costs with a projected 235 value at a 10% appreciation at a 4.5% interest rate on a 30-year fixed. This person is looking to cash flow $98 and their ROI is 22%. Now, a lot of you are saying cash flow $98. That sounds awful. One of the things I want to turn your attention to, especially if you haven't held real estate yet, cash flow should be icing on the cake. Okay, one of the things you need to pay attention to is appreciation. I want you to see the net year income of year one, right here, $948. No one's excited about that, right? Look at this equity growth in 30 years, $705,000. Estimated profits in 30 years, $968,000. Cash flow in 30 years, $35,000. Now, you may hold this property for 30 years. You may hold it for 10 and wait for the appreciation and take out the equity to buy an apartment complex. Hell, you may just buy it to take out the equity and profit out. Appreciation is the game in holding real estate. Now, this person projected more than a $1,500 rent because they're doing short-term Airbnb. Now, I looked in AirDNA, and it looks like $250 a day is reasonable. And it looks like having about 50% occupancy is reasonable in that time period. So if I was $250 a day, let's times 15 days, that puts you at $3,750 a month on average, off season and stuff like that. Look at your numbers now. Cash flow, $2,348.80. ROI, above 100, which is affinity, 541%. Your equity stuff and your appreciation doesn't change with income, because it's based off the value appreciation of the property. Your DSCR 2.68. We do loans on 30-year fixed where it is based off the air DNA or the current. If you're buying a current Airbnb property and they have stats that show how much it rented for, we can actually use that if you're going to keep that business program. So this is what it looks like when you're buying real estate. When you're buying real estate to hold, this down here. I want you guys to pay attention to that. When you're buying this real estate, this is how you change your wealth. This is how, when people say, buying 10 and, becoming a millionaire, because over time you're paying that note down. Over time, the property should be appreciating, depending on where you live and what market, because we'll do loans all across the United States. We just we were founded in Houston and Texas, so we know the Texas market a lot better. But you could be in Indianapolis right now and you need a 30-year loan or a short-term rehab, give us a call. We can help you out. So that's what I mean about looking at the numbers. How, if you are, you're like saying, well, I have about 20, 30 grand. Yeah, you can do this. You may have a property that you own free and clear. You can cash it out and buy more. You can fix something up. I don't want you guys to feel that you're pigeonholed when you're dealing with asset-based lending. A lot of times people, the only time that they've ever bought a house was their own personal property. So they remember that very black and white type of rigidness. In investment lending, there is gray areas, okay? If it makes sense, we can usually do it, okay? So this was a quick synopsis on how short-term lending works when you're fixing it up, how long-term lending works when you're getting into non-QM space, the non-qualified mortgage. Remember, you can go as low as 3.85. 2 years ago, non-QM lending was at 6s and 7s for a 30-year fixed. I mean, this is the time to act. A lot of people are saying, well, real estate's so expensive. I'm waiting for the market to change. If you position yourself appropriately, you can make money in any market, okay? And it is not thought that the real estate's going to be going down, okay? So yes, when the market shifts, there may be times to be able to buy properties a little easier, but values are going to be pretty steady, at least in my opinion, okay? So if something like this interests you, and let me know how you can get in with us. We can go over your business plan, whatever you need, okay? And those of you that are not used to Facebook Lives, you can always comment. You can ask questions. I'll answer them live for you, whatever you need, okay? So just make sure that you get with us, get with Eric, get with Rob, Nikita, Chelsea. They're all here to help you with your business plan. They're all here to help you grow, okay? We'll let you know, hey, I think you should do this. Or you may say, well, I want to buy 20 in the next 2 years. We'll say, okay, this is how you do it. Get with a team that's going to help you grow your business. Don't get me wrong, Jet Lending loves to do loans, but we notice that if we make our clients successful and you guys make more money, you'll buy more houses. So spend some time with us. Let us help you get a good business plan going on your buy, fix, and holds, or just you're buying them already rehabbed and you're buying just to hold them. You could buy them, you could fix them, you could rehab them. A lot of people are doing the Burr method, So just get with us so we can tell you what you can and can't do. And don't let what you can't do today stop you from doing something tomorrow. Someone emailed me and was like, well, I can't do this. I don't have the money to buy real estate yet. Today, but knowing this allows you to set up your finances for the future. Don't let something you can't do today stop you from making money tomorrow, okay? So get with our team. You'll notice this is scrolling on the bottom. Visit jetlending.com. You can email us at info@jetlending.com. You can call or text us at 281-872-7800. If you found this video interesting, please like it, share it, join our Facebook and YouTube channels. We come up with a lot of interesting topics and stuff like that all the time. If there's something that we didn't talk about today that you want to hear, Even if we did a video in the past, let me know. We'll redo it again. Our job here is to make sure that you have the knowledge and the skills and the team to grow your business and to grow your wealth. So that's all going to be for today. If you need anything, please reach out to our team and we'll make sure you're taken care of. And we hope you have a great day.